So we get asked so many times, how can I borrow more money for my mortgage? Now, before I tell you the answer to that, what I want to say is affordability isn't a target, it's a budget. So we need to make sure that the monthly repayments are affordable now and in the future. And if somebody says to you, you can borrow £500,000, doesn't mean you go straight out and try and borrow all of that money. It's an affordability assessment, not a target. Right, enough from me. In this video, we're going to talk about how you can borrow more money potentially on your mortgage and a few little hints and tips of how you can maximize that. My name's Sam, a mortgage expert here in the UK, and on my YouTube channel, I break things down like mortgage affordability, buy-to-lets, mortgage products, fixed deals, variable rates. The list is endless. So if you're looking at buying your first home, do me a favor, like and subscribe. Emma and Chris behind the camera will love it if our view counts go up and our subscriber base, so please do that for me. Right. Enough of that, let's get to it. So the first things first is understanding your gross affordability. So factors including the affordability are invariably your gross annual income. Now that's going to be how much you earn on a monthly basis. We'll calculate that on an annual basis. We'll look at bonuses, overtimes, commission payments, car allowances, you name it. If it's gross on the left-hand side of your payslip, lenders can use that towards affordability in different ways. They're going to look at that with your monthly spending. So we're going to do a credit assessment, look at your subscriptions, bills, childcare, debts in terms of loans, credit cards, overdrafts, Klarna, yes. Lots and lots of people have that, and ClearPay, it's that easy to use. Now they're going to look at those two things and look at your credit score and your repayment history. Credit score is really important because if you have loads of credit and you miss your payments, then you're not looking like a great bet for lenders. They're also going to look at your job stability and the types of employment as well. So we need to make sure, or have a look, should I say, if you're in employment at the moment, are you in a probationary period, how long that's for, how long you've been working for your employer, all that kind of thing. Now we're going to look at the existing debts and liabilities, and lenders are also going to stress test this to make sure that you can afford the payments now and in the future if interest rates rise. So we're not just looking at the payments today, but we're going to look at them in the future. So the more financially stable you are and responsible that you appear, the higher the borrowing power. So the higher the income and the lower your debts invariably means you can maximize your income. So a few ways you can improve your affordability before applying for the mortgage. Now, if you know a pay rise is due and your employees had it on the table, you can go and ask them for it and say, look, I'm due a pay rise, I'm applying for a mortgage. And if you are set to have a pay rise, lenders can potentially use that letter to say, look, Sam's salary is being increased by £5,000 per year. It's going to start from the first of next month. Some lenders will include that, so that can boost your affordability. If your employment offers regular overtime or you get paid commission, hammer the overtime, hammer the commission in the lead up to it. You're going to have more money in the bank towards your savings and your moving costs. Plus, on your payslip, it's going to show more money. So lenders are going to look at that and say, hey, you're actually earning more money each month than what we think. Now, if we look at income on your own and you're buying on your own, and it's not enough to get where you want to, you might want to consider having somebody else on a mortgage application with you. So we can do this in terms of a co-owner. So you can own the property in tenants in common or joint tenancy. We'll have a whole nother video on property ownership. And both incomes together would boost that affordability. If you don't have anyone that wants to buy the house with you, you can also look at what's called a joint borrower sole proprietor mortgage, which will be you on your mortgage application and a second person, but they don't own the house. Essentially, it's like a guarantor mortgage. This is commonly used if you're living in areas where the house prices are booming and they're surging up at the moment, and you might have a friend or a best mate, a family member, a parent maybe, sit on an application to say to a lender, look, use my income, I'm the person who's going to own the home. Put them together, boost the affordability, and away you go, you can purchase it. Another way you can look at is reduce your monthly outgoings. Now, I mean just spending less income overall. It's so easy this day and age, just you use your Apple Pay or Google Pay, you tap on your phone wherever you go. I mean, who even uses a bank card these days, right? It's so easy to spend money. We need to make sure we've got a bit of a handle on that. So what I would do is I'd go through your bank statement and I'd get rid of any unused subscriptions. The audio books that you've not used in 6 months, get them gone. Spotify Premium, do you really need it? Do you really need Spotify and Apple Music? Just pick your favorite one and stick to it. Now also there's Disney Plus, there's Prime, there's Netflix, the list goes on. Just have a look at what you're not using at the moment and see how much you can slice off on a monthly basis. One, it helps you save anyway, and two, it cleans up your bank statements. I'd also look at switching to cheaper utilities or phone plans. So if you're paying 60, 70 quid on a phone and you're coming to the end of your contract, it's so easy just to take the latest phone, which is what I'm party to. But if you don't need to, phones, technology is fine. If you've got the iPhone 14, you don't need to go get the latest one necessarily and spend another 70 quid. Just switch it to an air-only plan, I think they're called, $9.99 per month, and away you go. You saved yourself 60 quid already. You still got a half-decent phone, unless your screen's cracked, and you absolutely need it. An easy tip as well is to reduce the amount of takeaways. Now, I know on a Friday we finish work, and if you drink beer, you might fancy beer and a quick takeaway, but sometimes it can be 30, 40 quid, depending on the cuisine that you decide on as well. Now, it's not essential. Get yourselves a Nando's homemaking kit, get some chicken wings, get your beers anyway, cook from home, and when you're in your new house, you're not going to be reliant on that Friday night takeaway because you'll be better at cooking as well. Look at that. So even small savings like that can help along the way. Boost your savings and means you've got more money in the bank. Now, a key thing to this as well is we can pay off debts. You should pay off debts if you can pay them off and reduce how much that you borrow. A thing for me is Klarna, ClearPay, all those sorts of buy now, pay late schemes are so easy to use. Before we know it, our bill can be 2, 3, 4 grand. That's going to have an impact on your affordability. So bring them down where possible and stop spending on them, right? 24-hour rule, if you want to buy something and you usually impulse, stop, sleep on it, put a timer on your phone for 24 hours and see how you feel after that. And if you really, really want to buy it, then buy it. But giving yourself 24 hours, I personally found I actually buy less impulsive things anyway. The other things to look at are credit cards, loans, overdrafts. Make sure where we can, we're paying them off. Don't be applying for any loans towards your mortgage. So let's say, for example, you move and you think, oh, actually, could do with an extra 2.5 grand towards my holiday. Just forget it, save the money, take your time. A new loan appearing on your credit file can impact your affordability, but also could lower your credit score as well. So it might affect those chances. Speaking of credit scores, always have a look at the main three. Experian, Equifax, or TransUnion. Most lenders use 1, 2, maybe a blend of all three to look at their credit assessment for you. So we need to make sure that any errors on them are fixed. We need to make sure all your payments are green or showing a status of 0 on some of them, which means you're paying on time. But we need to fix any errors. Voters roll, we need to make sure wherever you're living at the moment, you're showing on the voters roll because lenders will check that straight away as soon as we press submit. Make sure your payments are made on time. And like I said before, avoid multiple credit applications close together. If you're looking to buy in the next 6 months, really, you want to stay from any credit applications anyway, just to be on the safe side. Lenders want proof that you're going to manage money responsibly. So having high credit card utilization, late payments, missed payments, using Klarna and things like that every single month. The lender's going to look at all this data and go, obviously you're overspending. So we just need to make sure we're positioning your application in the best possible light to the lender to maximize that affordability. Another option is having a bigger deposit. Now, larger deposits lower the lender's risk and improve your options. One, by way of interest rate anyway. The bigger the deposit, typically you find it's a lower interest rate you'll be paying. So it's cheaper monthly for you. But sometimes the bigger the deposit that you have, the more flexible lenders can be on affordability. So if you've got a 30% deposit versus a 5% deposit, lenders might say, actually, we can lend you a bit more because if we ever need to repossess the house, we've got a better chance of recovering the money that we've lent you as well. So just a bit of guidance on that. If you're buying for the first time, you can use government schemes like a lifetime ISA, where you get boosts into your savings to increase the money that you have to boost your deposit into the house, which can boost your affordability. Even an extra 5% can unlock the next interest rate or higher borrowing. Now, what I'd always say is if you're planning on buying a house, maybe over the next 12 months, I'd speak to a broker as soon as you can. Because what we can do is piece together that journey for you. So where you are now, you might have a 10% deposit. You're not in a mad rush to buy. If it's going to take 6 months, 7 months, can you set a target for yourself to save an extra 5% deposit? What does that look like? Or is it going to be a 12-month period? And you can have regular check-ins with your advisor to help you get mortgage ready so that you understand today your long-term plans over the next 12, 18 months, even 2 years to make sure that you're getting the right affordability, the right product, and you know absolutely everything there is to know about your mortgage. And we can all breathe. I've just rattled through a lot there in that video, so apologies for that. But once I get going, Emma and Chris, who sit here for hours on end watching my videos, know how much I can rant about this stuff. Now, if there's anything specific that you want me to go through, please drop me a comment below. As always, if you want to speak to me confidentially, you can email me. It's sam@ukmc.co.uk. As I said in the start of the video, please like and subscribe. I'll shut up now and leave you to the rest of your day. I'll see you soon.